On April 21st, 2026, Agree Realty Corporation reported its seventh consecutive quarter of record revenue, $200.8 million, up 18.7% year over year. And then they did something most REITs don't do at earnings. They raised their acquisition guidance. Not trimmed it, raised it. From $1.2 billion to $1.4 billion for the full year.
The stock is trading near a 52-week high. 9 of 14 analysts covering ADC have a buy rating or better. Raymond James is at strong buy. Nobody has a sell. And the monthly dividend has been raised for 14 consecutive years. This is about as consensus positive a setup as you'll find in the net lease REIT sector.
Welcome to Charged Alpha. I'm Hudson Thomas, here with Lana Chen. Today we're breaking down Agree Realty Corporation, ticker ADC, the Royal Oak, Michigan-based net lease REIT that just delivered its seventh straight record revenue quarter while trading near a high rather than a low. Over 2,200 properties across all 50 states, 68% of rent from investment-grade tenants, a monthly dividend that compounds like clockwork, and a founder-family CEO who grew up inside this business. Let's dig in. Agree Realty Corporation was founded in 1971 by Richard Agree in Michigan. The company went public in 1994 and today is headquartered in Royal Oak, Michigan, with a lean team of just 75 employees managing a $10 billion real estate portfolio. It operates under one segment, net lease retail properties, acquired and developed across all 50 states.
The net lease model is the key. When ADC acquires a property, the tenant, not ADC, pays property taxes, insurance, and maintenance costs. That's the triple net structure. ADC receives the rent check, period. The result is highly predictable, recurring cash flow with minimal operating cost variability. The model is simple to understand and extremely powerful when executed at scale with the right tenants.
Tenant quality is what separates ADC from the pack in the net lease space. Approximately 68% of ADC's annualized base rent comes from investment-grade rated tenants. Retailers like Walmart, Dollar General, Dollar Tree, Tractor Supply, Amazon-anchored properties, and Home Depot. These are not the mom-and-pop single-tenant deals that populate lower-quality net lease portfolios. These are the anchors of American necessity retail.
The why now for this quarter is straightforward. ADC delivered the seventh straight record revenue quarter. $200 million crossed in Q1 to 2026 for the first time. Revenue grew 18.7% year over year. EPS beat estimates by 4.4%. And management raised acquisition guidance by $200 million. The investment debate isn't about whether ADC is a good business. The consensus buy rating says the street agrees it is. The debate is whether the roughly 16 times AFO multiple is justified relative to peers like Realty Income, which trades at a discount.
Agree Realty is run by Joel N. Agree, son of founder Richard Agree, who became president and CEO in 2013 after working his way through the business. He holds a law degree from Michigan State and a business degree from the University of Michigan. This is a genuine second-generation family business leader, not a hired executive from an unrelated industry.
The transformation Joel has driven is remarkable. When he took over, ADC had roughly 150 properties concentrated in Michigan, and the tenant quality was far more mixed. Today, there are over 2,200 properties in all 50 states, and the investment-grade tenant percentage has risen from under 30% to 68% of annualized base rent. That is a deliberate, multi-year quality upgrade that most REIT managers wouldn't have the patience or discipline to execute.
Joel Agree is regarded as one of the sharpest capital allocators in net lease. He has repeatedly slowed acquisitions when cap rates compressed below his hurdle rate, accepting slower growth rather than destroying the accretion math, and accelerated aggressively when spreads widened. The raise in full-year acquisition guidance from $1.2 to $1.4 billion is a signal. He sees cap rates and deal quality that justify stepping on the gas right now. Take us through the Q1 2026 financials.
Agree Realty trades at $78.86 per share with a market cap of $9.47 billion. The GAAP price-to-earnings ratio is 43 times. But that number is largely meaningless for a REIT because GAAP net income excludes depreciation, which for real estate companies is a massive non-cash charge that overstates the true cost of holding properties that are actually appreciating in value. The number that matters is price to AFO, adjusted funds from operations. At roughly 16.3 times AFO, ADC trades at a modest premium to its net lease peers, reflecting the market's willingness to pay up for its superior tenant quality and growth track record.
Walk us through the Q1 income statement.
Revenue came in at $200.8 million, 18.7% above Q1 2025 and 2.5% above the $196 million estimate. That revenue beat reflects both new acquisitions and healthy same-store rent escalations baked into long-term net leases. GAAP EPS was 50 cents, beating the 47.9-cent estimate by 4.4%. The more relevant REIT metric, FFO per share, was approximately $1.05, and FO per share, which backs out acquisition costs and adds stock compensation, was approximately $1.21 for the quarter. Annualized, that puts full-year AFO run rate at roughly $4.80 per share, consistent with management's guidance range of $4.80 to $4.90.
And the cash picture?
Excellent cash generation, which is expected for a net lease REIT with near-perfect occupancy. Q1 2026 operating cash flow was $145 million. On a trailing 12-month basis, operating cash flow was approximately $523 million. Free cash flow matches operating cash flow for a net lease REIT since maintenance CapEx is minimal. Tenants handle it. The balance sheet carries approximately $3.35 billion in debt against a $10.2 billion total asset base, a debt-to-equity ratio of 0.54 times, and net debt to EBITDA of 5.4 times, which is standard for investment-grade net lease REITs. The dividend payout ratio based on AFO is approximately 64%, leaving meaningful room for continued dividend growth. Overall, Agree Realty Corporation's financial health is solid. Investment-grade balance sheet with net debt to EBITDA at 5.4 times, AFO coverage of the dividend at 1.56 times, and TTM operating cash flow of $523 million. The primary financial watch point is acquisition financing. At $1.4 billion in planned acquisitions for 2026, ADC will need to access equity and debt markets efficiently to maintain the accretion math.
What does analyst sentiment look like on ADC right now?
Strongly positive, and that is unusual for a stock trading near a 52-week high. 14 analysts cover ADC. The consensus is buy. 9 firms rate ADC as buy or equivalent. Raymond James at strong buy, along with Truist's, UBS, RBC Capital, Stifel, Wells Fargo, KeyBank, Evercore IS, and Baird. 5 firms are in hold territory: Barclays, BMO Capital, Mizuho, JMP Securities, and BTIG. There are 0 sell ratings. For a company at the top of its valuation range, that's an unusually clean consensus.
What are price targets telling us?
The average price target sits around $88, implying roughly 11.5% upside from $78.86. Target range runs from approximately 78 on the low end, essentially flat from current levels, to 98 on the high end. The average target is barely above the 52-week high of $82, which suggests the consensus is constructive but not euphoric. The analysts maintaining hold ratings cite the valuation. At 16 times AFO, ADC is priced for near perfection relative to peers.
Were there any notable moves heading into Q1?
One notable downgrade just before earnings. BMO Capital moved from outperform to market perform on April 17th, 4 days before Q1 results, specifically citing valuation concerns. That move was offset by UBS upgrading from neutral to buy in January, pointing to improving acquisition cap rate spreads. The BMO downgrade is worth watching. It signals that at least one major institution believes the premium multiple is fully earned, and that further outperformance requires continued acquisition excellence and a supportive rate environment.
Let me make the bull case for Agree Realty. First, the tenant quality is best in class. When 68% of your rent comes from investment-grade companies, you're collecting money from Walmart and Dollar General, not from a local pizza chain. That credit quality generates stability that competitors with lower quality portfolios simply can't match. Second, The acquisition machine is accelerating. Management raised guidance to $1.4 billion in acquisitions for 2026, at cap rates approximately 130 basis points above the cost of capital. That spread is direct AFO accretion for shareholders. Third, the dividend compounder. A 3.9% yield on a monthly payer with 14 consecutive years of raises is an extremely competitive income profile, especially with the payout ratio at 64%, providing ample cushion. Fourth, the lean operating structure. 75 people managing a $10 billion portfolio is one of the most efficient organizational models in public REITs. G&A leverage means revenue growth flows through to AFO at a high rate. Fifth, Joel agrees track record is exceptional.
The bear case is real. First, interest rate sensitivity. Net lease REITs are long-duration assets. Their value is the present value of decades of rental income, and when rates rise, that present value falls. ADC declined sharply in the 2022-2023 rate cycle, and any reacceleration of inflation or Fed hawkishness would pressure the entire sector. Second, the premium multiple. At 16 times AFO versus realty income at roughly 15 times and NNN at 14 times, ADC's premium requires continued execution. Any acquisition slowdown or AFO miss would compress the multiple and could create meaningful downside. Third, retail sector risk. Even investment-grade tenants can surprise. Dollar General has been managing through operational challenges, and drugstore chains like Walgreens have been closing locations. If a top 10 tenant declares bankruptcy or announces a major store rationalization, ADC's occupancy and rental income could be impacted. Fourth, equity dilution. Growing at $1.4 billion per year requires ongoing equity issuance. More shares outstanding dilutes per share AFO growth and is only justified if acquisition cap rates stay well above the cost of equity capital. Fifth, cap rate compression risk. If competing buyers push up property prices, the accretion math narrows.
How does Agree Realty stack up against peers on valuation?
On price to sales, ADC at 12.6 times looks expensive relative to peers. But that comparison is misleading for net lease REITs because PS ratios vary dramatically with portfolio size and vintage. The better comparison is PFO. ADC at 16.3 times AFO trades at a premium to realty income at roughly 15 to 16 times, and a more significant premium to national retail properties trading around 14 to 15 times. The premium is the market charging a quality surcharge for ADC's higher investment-grade tenant concentration and faster growth rate.
What about Essential Properties Realty Trust as a comp?
Essential Properties is actually the most interesting comparison right now. EPRT is growing even faster than ADC, revenue up 21% year over year, but its tenant base is very different. Essential focuses on service-oriented tenants, car washes, quick-service restaurants, childcare, veterinary clinics. These tenants are also largely non-discretionary but carry different credit profiles than ADC's investment-grade retail roster. EPRT trades at a slight PS premium to ADC but typically at a PFO discount. The market is paying more for ADC's credit quality and paying more for EPRT's growth. ADC sits in the sweet spot, faster growing than realty income with better credit quality than EPRT.
So ADC's premium is earned?
The data says yes, as long as execution continues. The quality-to-growth combination ADC offers is genuinely differentiated in the net lease sector. Realty income is bigger and more diversified globally, but its growth rate is slower. NNN is more domestically focused but lower quality on tenants and less active on acquisitions. The scenario where ADC's premium evaporates is if interest rates stay elevated for years, compressing cap rate spreads below ADC's cost of capital and forcing a slowdown in accretive acquisitions. That's the risk. The base case is that the premium is sustainable.
On the options side, specific put-call ratio and implied volatility data were not available for this episode through our primary sources. What we do know is that ADC carries a beta of 0.52, moderate for a REIT, which means options are structurally inexpensive relative to higher volatility equities.
The low beta reflects ADC's defensive net lease cash flows. When the economy softens, people still go to Dollar General and Walmart. The tenants pay the rent because it's a fraction of their operating costs, and walking away from a net lease means leaving a profitable location. The most interesting macro options dynamic in net lease REITs right now is interest rate positioning. Traders using REIT options as rate sensitivity hedges. Any Fed pivot toward cuts would likely produce an outsized positive move for the entire sector, with ADC positioned near the high-quality end of that trade.
On insider activity, formal transaction data was not available through our primary sources for this episode. What we know is that the Agree family has maintained meaningful equity ownership since the company's founding in 1971.
For a founder-led REIT like ADC, the insider alignment comes through the family ownership stake and Joel Agree's compensation structure, heavily weighted toward long-term performance equity rather than short-term cash bonuses. That structure aligns the CEO's financial interests with long-term AFO per share growth and dividend sustainability, not with hitting a quarterly number. The fact that no major insider selling has been flagged around Q1 earnings is consistent with management confidence in the forward acquisition pipeline and the FY 2026 AFO guidance they maintained.
The key risks for Agree Realty going forward. Risk 1. Interest rate sensitivity. The 10-year Treasury yield is the gravitational force on net lease REIT valuations. Any material move higher would compress ADC's multiple and could offset the fundamental AFO growth story. Risk 2. Retail sector disruption. Even investment-grade tenants are not immune to long-term secular shifts. Drugstore chains have been rationalizing locations aggressively, and any acceleration of that trend in ADC's top tenants would create occupancy headwinds. Risk 3. Acquisition cap rate compression. If more capital chases net lease properties, the spread between acquisition yields and cost of capital narrows, slowing AFO accretion.
Risk 4. Equity dilution. $1.4 billion in annual acquisitions requires ongoing capital market access. In a rate rise or credit tightening environment, the cost of equity rises and acquisition accretion shrinks. Risk 5. Concentration risk in top tenants. Dollar General, Dollar Tree, and Walmart collectively represent a significant share of ADC's rent roll. Any major operational deterioration or store closure campaign from these anchors would be material. The single watch point that matters most heading into Q2 2026 is AFO per share. Management guided to $4.80 to $4.90 for the full year. If Q2 AFO per share comes in at or above $1.20 per share, the compounding thesis is intact. If it misses, the premium multiple becomes much harder to defend.
So what is the bottom line on Agree Realty Corporation? The Q1 2026 results were excellent. Revenue of $200 million, up 18.7% year over year, beating estimates. EPS beat by 4.4%. AFO per share of approximately $1.21 puts the full-year run rate at $4.80 to $4.90, consistent with management guidance. Management raised acquisition guidance to $1.4 billion. Occupancy remains near 99.7%. The monthly dividend yields 3.9% on a 14-year streak of raises.
The valuation is the honest tension. At roughly 16 times AFO, you're paying a quality premium for a business that has earned it. But the premium only makes sense if interest rates cooperate, acquisitions continue to clear the cost of capital, and key tenants like Dollar General and Walmart don't generate negative credit surprises. The investment case for ADC is a patient income compounder, a best-in-class net lease platform with a monthly dividend that has compounded for over a decade at a premium multiple that reflects genuine quality. The watch point is Q2 AFO per share and any signals from management on whether the $1.4 billion acquisition target is tracking to plan.
We'll leave you with Joel Agree's guiding principle for the company he inherited and elevated. We are focused on building the highest quality net lease portfolio in the country, one property at a time. Our tenants are not going anywhere. They are the backbone of American retail, and they need locations that work for a generation, not a quarter. A CEO who grew up inside a family business, who traded up the tenant quality while tripling the portfolio, who raised acquisition guidance at earnings, and whose stock sits near a 52-week high because the fundamentals earned it. That's going to do it for this episode of Charged Alpha, your deep dive into Agree Realty Corporation, ticker ADC. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.